You're making decisions based on what's happening with the spot chart, but you're executing your trades on the options chart. This can get a bit tricky. Imagine being able to predict how much your options price will change with every rupee move in the underlying asset. That's exactly what Delta does. It's not just a number. It decides the fate of an options trade. Stick around to learn how Delta can help you fine-tune your stop-loss strategy and protect your trades like never before. Delta is a key concept in options trading that tells you how much the price of an option is expected to change when the price of the underlying asset, like a stock or an index, moves by 1 rupee. For example, if an option has a delta of 0.5, this means that if the index price goes up by 1 rupee, the options price is likely to increase by half a rupee. Similarly, if the stock's price drops by a rupee, the options price is likely to decrease by 0.5. These numbers are focused on options that are about a week or two away from expiring. Keep in mind the rules might change slightly for options with longer expirations. Also, if you're not familiar with terms like ITM, that's in the money, at the money, or out of the money, we've covered those in a previous video. You can find the links in the comments. These are some general guidelines about using Delta that can help you set your stop losses when trading options. Here's a quick breakdown. In the money options, ITM options usually have a delta of around 0.6 or higher, meaning for every 1 rupee change in the underlying asset, the options price will change by about 60 paise or more. As the option gets deeper into the money, delta increases, making it even more sensitive to price changes. At the money options, ATM options have a delta of about 0.5. This means there's an equal chance of the options price moving up or down with the asset's price. It's a balanced position, neither too risky nor too safe. Third, out of the money options, OTM. OTM options typically have a delta of around 0.4, and this value gets smaller as the option moves further out of the money. This means OTM options are less sensitive to price changes in the underlying asset. If you prefer finding precise delta values, there are many option analysis apps available that can help. Personally, I use the option chain on Market Pulse for a quick and easy look at these values. Now let's dive into an example to see how you can apply this in your trading. Using Delta to set stop losses. Let's say you're bullish on the Nifty index and you identified strong support. You decide to buy a 25,250 call option priced at 150 rupees. This call option is an ATM or at the money option, which typically has a delta of 0.5. When you check the precise delta value, it's 0.53, which is close enough to our estimate. Now to set a stop loss, you look at the difference between the price you bought at and the support level. The difference is 50 points. Since your delta is 0.5, you multiply this 50-point difference by 0.5, giving you 25 points. This means you'd set your stop loss at 125 rupees, that is 150 minus 25 for that option. On Punch, you can easily set the stop loss with just a few clicks, and if you want to set a profit target based on your risk, you can do that at the same time. To illustrate further, if you were trading the 25,350 call option with a delta of 0.4, your stop loss would be 0.4 times the 50-point difference, which is 20 points. If you're trading an in the money option at 25,150 call option with a delta of 0.6, your stop loss would be 0.6 times 50, which equals 30 points. Leave a buffer of a point or two below your calculated stop loss level to account for sudden price movements that can happen in options trading. Keep in mind, when you start trading, it's normal to make a few mistakes while setting your stop losses. But just like in life, you'll learn from these mistakes and become a better trader over time. The key is to find that sweet spot for your stop loss, which comes with experience and practice. Lastly, remember that trading comes with both wins and losses. It's important to accept this and focus on protecting your capital so you can continue trading another day. And even when you're doing well and making gains, don't ignore your stop loss. Keep your goals realistic and avoid getting too ambitious. So to all those saying don't want to use it, remember, a stop loss is essential. It's your shield against market surprises when you're not glued to the screen. In the next video, I'll share another practical technique that is mathematical and precise, which you can immediately use for smarter stop-loss placement. Stay tuned for our next video. Thanks for watching. Remember, trade smart, stay safe. Catch you next time.